Hey there, this is Casey Lown with Strategic Mortgage Solutions here for the Tuesday Mortgage Talk. Hey, if you're an investor or you're a realtor or somebody who advises real estate investors with acquiring properties, flipping properties, you'll want to tune into this particular video chapter here because I'm going to talk about a real life situation I'm currently helping somebody get a loan for. It's for this investor, and I want to share this with you because personally I think it's pretty amazing. If many of you don't already know, the backstory is that investors in this lending world oftentimes come across banks and lending institutions that say no, because maybe they only offer a limited amount of product. Maybe they only offer conventional financing for investors. Conventional financing are loans that are offered and endorsed and underwritten by Fannie Mae or Freddie Mac standards. Those particular institutions and that underwriting style can be very restrictive, very limiting, and financial document heavy in terms of the amount of documents a borrower has to submit to show the ability to qualify for the loan. In many cases, when you have somebody who flips homes for a living, or you have an investor that buys and holds property, but they have more than 10. Maybe it's somebody who's self-employed who does a little bit of contracting over, works on the side as a contractor, does a little bit over here or there, just doesn't do enough business or show enough business activity on their tax returns to show the necessary ability to repay for one of these conventional mortgages. That's where a non-prime mortgage could come in handy. And that's the case with my particular client, who I was referred to by another mortgage professional here locally. This particular gentleman came to me because he was having difficulty getting financing anywhere else. You see, he was a part-time contractor who has several investment holdings, several investment properties, I should say. And, really, if you look at the whole scheme of things, guy was in pretty good shape. His property's cash flow, he's got good equity in them, but on paper, on his tax returns, he didn't show enough taxable income net from all these different activities to qualify for a traditional conventional loan. That's when I was able to do some research and give him a solution that was a little bit different than everyone else. I have several non-prime lending channels. If you're not aware, non-prime is the new name for subprime. However, these new subprime, non-prime loans are more of a make sense type loan. They're good lending type loans than previous loans, which would require maybe would allow for low credit score, no money down, and by the way, you don't even have to document your income. In this particular case, the new non-prime, subprime loans are loans that are a bit more conservative. They require the borrowers to have more skin in the game, more equity, more down payment. Less documentation is only allowed if you're a self-employed borrower, and even then it can be somewhat restrictive, but not as restrictive as a conventional loan. In this particular case, this particular client, I was able to get qualified and pre-approved for a refinance of his loan. He had a private money loan at 12%. It's on a home that he bought less than 12 months ago. It was a bank-owned property that he went in and did a cosmetic flip, but he had to get this private money loan to cover the difference that he couldn't come up with down. It's at 12%. It's a pretty hefty interest rate and a pretty hefty payment, which is really hammering down his ability to generate decent cash flow of that property. So with the non-prime loan I was able to offer, I was able to find a lender that could do what we call a debt service coverage ratio type loan. That's a loan where they exclusively look at that property and the rents received from that tenant for the ability to repay on that mortgage. As long as, in this particular case, the tenant's rent was of an amount that not only covered the mortgage, but a little bit more, this case 25% over what the new principal interest tax insurance premiums would be on that home, then that was a loan that was good for that lender. They would actually lend, in this case, at an interest rate of 5.5% on a 30-year fixed loan for a borrower with a 680 credit score. And if you think about that, if you yourself or you've had clients who are investors going out there and getting mortgages, and you've talked to them about that, it's not a bad interest rate. In fact, from what I find, it's only about a half a point, maybe 6/8 of a point higher in interest rate than they would otherwise get with the standard conventional loan. And you think about that, that's pretty amazing. That's really good money. Just several years ago, 3, 4 years ago, somebody couldn't even get one of these loans without an interest rate of 8% behind it. Most other people were offering private money loans that were in the 12 and 14% range. So in my mind, I think this is phenomenal. It's a great opportunity if you, as an investor out there, are interested in getting other options or ideas for financing your next investment property, properties that you currently have financed already with higher interest rates. Give me a call, IM me, or email me. I might have some very interesting solutions for you for a multitude of different investor type loans and how to document the ability to repay. This is Casey with Strategic Mortgage Solutions. Have a great day.